Hello and welcome back to The Note. 2013 has been full of pleasant surprises for investors, but arguably two of the greatest came from the Federal Reserve in the US, which decided not to taper off its QE bond purchases despite much belief that it would do so, and also from the Eurozone, where many people thought that there would be another leg of the sovereign debt crisis this year, and that hasn't happened. How have we managed to avoid those bullets, and what are the chances that we will continue to do so in 2014? With me now to discuss this is the European Head of Interest Rate Strategy for Barclays, Laurent Fransolet. Laurent, thank you very much for joining me today. Let's start by taking a look at a very interesting chart you drew up showing the return on Italian bonds compared to various others. Take me through this.
Well, the chart is showing you the total return of bonds since the beginning of the financial crisis, and it's a very good illustration of the various episodes in the crisis. At the very beginning of the crisis, financial markets are dropping and all bonds are rallying, and then from 2010 onwards you can see that there is a big differentiation with Italian bonds lagging while all the safe haven bonds are rallying.
Which is the Eurozone crisis.
The Eurozone crisis. Right. And then from the middle of 2012, the Mario Draghi, whatever it takes speech, what you can see is that Italian bonds are rallying back, are catching up with German bonds, while in fact all the other safe haven bonds are basically flat to slightly down since then. And what we expect is a continuation of this pattern, basically, with the old bonds being more correlated going forward, but stable to down.
Okay, now let's take a look at another chart which takes us through how Spain and Italy performed. And I gather Italy, there's more of a lag with the data. Why should we be so confident? These are obviously the critical countries in the Eurozone crisis. Why should we be so confident that we're not going to get another leg of the crisis out of either of those?
Well, there's been a number of things which have made us more confident about the situation in the Eurozone. One is the progress on the institutional framework with the banking union. Second thing is that there's been a noticeable reduction in the twin deficits, budget deficits and current account deficits. And the third one, and probably more underappreciated by investors, is that actually when you look at the ownership of these government bonds, they've been quite stable over the past year and a half, i.e. there was very large liquidations by foreign investors in 2011. Since then, a lot of the rating sensitive investors, Asian investors, Northern European investors, have not come back to these markets, but they don't have anything to sell anymore. And so it's been much more stable.
So there's a limit on contagion. It means that it's not foreigners who've gained from the recovery in the last 18 months, but it also means that the crises stay contained within their home countries.
Exactly, John. So, and in particular, the foreigners who have actually stuck to these markets have actually returned on their bonds something like 10% in 2012 and in 2013, while safe haven bonds have returned very little. So they're quite comfortable, I think, with their holdings. What is interesting is we haven't really seen yet much of a return of the investors who left in 2011, except maybe the latest Spanish data, which shows a little bit of a pickup.
Okay, now let's finally make a quick trip to the States. Perhaps the last big question for this year is whether the Fed might just start to taper next week. A big part of that is exactly how benign the inflation picture is, and this is perhaps one of the more alarming charts I've seen on that for a while. Take me through Barclays' view on inflation as swiftly as you can for the US.
I wouldn't say it's alarming, but it's certainly interesting and not on the radar of a lot of people. The economy in the US has been doing better. Unemployment rate has been declining fairly consistently over the past 3 years, but inflation has been nowhere to be seen and has actually remained very, very low. What you are seeing in this chart is that as the unemployment gap has been slowly closing, is the blue line in this chart, you've seen that you've seen some pressure on wages. Here we're showing the number of small businesses planning to increase wage compensation. You can look at average hourly earnings. It gives you the same kind of picture. So the question is really, how long can the Fed remain very dovish against an improved economic picture? We think it can still do that for the next 3 to 6 months. But as we go into the middle of 2014, it's going to be a little bit more difficult.
Okay, Laurent, thank you very much indeed.
You're welcome.
In summary, for 2014, maybe we don't need to be worried quite as much about Europe as we thought. But if you want something that's not on the radar that could be an ugly surprise if it happens, it would be a hawkish move from the Fed. I don't think that's the central expectation yet, but the risk is there.